Hello and good day everyone. Today, we will present a comparative financial analysis of Mr. DIY and Aeon, two leading retail companies in Malaysia. Before we begin, here is an overview of our content. We will cover the annual reports and the financial statements of Mr. DIY and Aeon, including company background, management structure, financial performance, and a comparison between two companies. First and foremost, I will explain on the name of the company and their background. This slide introduces two companies, which is Mr. DIY Group Malaysia Berhad, established in 2005 and operating in the home improvement retail industry, and Aeon Company Malaysia Berhad, a retail company originally founded in 1926 and established in Malaysia in 2013. This is Aeon's 2025 organizational chart showing the company's top management including the CEO, CFO, COO, and other key officers. Next, this slide shows Mr. DIY's 2025 organizational structure, outlining the key executives such as the CEO, CFO, and other senior managers who oversee the company's operations and strategy.
Good day everyone. Today I will be presenting the key shareholders and the main business activities of Aeon Co Malaysia Berhad and Mr. DIY Group. Alright, let's start with Aeon. Aeon is subsidiary of Aeon Co Limited Japan, holding 51.7% of Aeon Malaysia shares. For Mr. DIY, Mr. DIY Group Berhad is a homegrown brand with B Family Limited holding 50.91% of shares. Let's talk about the three main business activities for the respective company, which we're talking about, obviously, Aeon Co Malaysia Berhad and Mr. DIY Group. Let's start with Aeon. Aeon's core business activities encompass a variety of sectors, with retail being a significant part of its operation. Aeon operates over 35 Aeon stores and 28 Aeon malls across Malaysia, offering a broad range of general merchandise, groceries, and specialty items to cater to diverse consumer needs. In addition to retail, Aeon also focuses on property management services with a substantial portfolio of properties that generate stable revenue streams. To further the enhancements of the reach, Aeon has developed its online platform My Aeon To Go, which provides customers with a seamless shopping experience, complementing its physical stores with convenience of online shopping. Let's move on to the Mr. DIY. The company's primary business activities include retail, e-commerce, and property investment. As the largest home improvement retailer in Malaysia, Mr. DIY offers over 17,000 SKUs across various categories such as hardware, household goods, electrical appliance, stationery, and sports equipment. The company has also established a strong online presence, operating an e-commerce platform that complements its physical stores by providing customers with a wide array of products for home improvement and everyday essentials. In addition to its retail and e-commerce activities, Mr. DIY has a robust property investment portfolio which includes property management and leasing operations through its subsidiary, Mr. DIY Management Sdn Berhad. Thank you. Let's move on to the next person.
Now, let's move on to the second part of this assignment, which is financial statement, and I'll be explaining about the first question of the financial statement analysis. In this section, I will begin by analyzing Mr. DIY Group, a leading home improvement retailer in Malaysia. Let's first look at the net profit performance for Mr. DIY Group over a 3-year period from 2022 to 2024. I have attached a table below to represent the net profit of Mr. DIY over a 3-year period. From this information, we can analyze that in 2022, Mr. DIY recorded a net profit of approximately 472.9 million ringgit. In 2023, this figure rose sharply to 560.7 million ringgit, representing a growth of 18.6% or an increase of around 87.7 million ringgit. This substantial improvement indicates that the company experienced a stronger sales performance and enhanced operational efficiency during the year. However, in 2024, the net profit grew at much slower rate, reaching about 568.9 million ringgit, which is only a 1.5% increase or about 8.3 million ringgit compared to the previous year. This marginal growth suggests that the company may be facing challenges such as rising expenses or market saturation. Continuing with the overall performance, Mr. DIY recorded a cumulative net profit increase of 20.3% from 2022 to 2024 and overall gain of nearly 96 million ringgit. This reflects a favorable profitability trend with strong performance in 2023 and stable result in 2024 despite possible cost challenges. Now, regarding the company's main business activity. Mr. DIY operate has a single segment business in the retail of home improvement product. This includes a wide range of categories such as hardware, electrical items, household furnishing, stationery, and sports goods. As shown in the table, Mr. DIY's entire revenue from 2022 to 2024 was generated from this one business segment. In 2022, revenue from retail was approximately 3.99 billion. In 2023, it increased to 4.36 billion, and in 2024, it reached about 4.65 billion. In each of these years, the contribution of retail activities to total revenue was 100%, as the company does not operate in any other business segment. So, to conclude this part, Mr. DIY's highest and only revenue contributing activity is home improvement retail, which accounts for 100% of the company's revenue across all 3 years. Now, moving on to the second company in our analysis, Aon Company, a major player in Malaysia retail and property management industry. Let's take a look at the net profit performance of Aon Company over the 3-year period from 2022 to 2024. In 2022, Aon reported a net profit of 111.2 million ringgit. In 2023, this figure rose to 114.8 million ringgit, marking a 3.2% increase or about 3.6 million ringgit. While the growth is relatively modest, it still reflects a financial stability, suggesting that Aon managed to maintain profitability through consistent retail operation and effective cost control. The more notable shift occurred between 2023 and 2024, when net profit jumped to 128 billion ringgit, representing that 11.5% increase or approximately 13.2 million ringgit. This significant growth points toward enhanced profitability, likely supported by an increase in revenue and better operational efficiency across its business segment. Now, let's look at the overall profit trend. Between 2022 and 2024, Aon recorded a cumulative net profit increase of 15.1%, amounting to a total gain of 16.8 million ringgit. This upward trend reflects a favorable profit trajectory, with more substantial growth in 2024, highlighting Aon's resilience and strategic adaptability in the competitive retail sector. Now, regarding the company's highest revenue contributing business activity, Aon's core income is generating from retailing. This includes the operation of departmental stores and supermarket, offering a wide variety of products such as clothing, food, and household goods. As shown in the table below, in 2022, retail contributed 3.53 billion ringgit or 85.1% of its total revenue. In 2023, it contributed about 3.45 billion ringgit or 83.7%. In 2024, the contribution stood at 3.52 billion ringgit, making up to 82.7% of its total revenue. Although retail remains the dominant source of income, the slight decline in its percentage share over the year suggests that Aon's property management service segment is gradually expanding. This shift reflects the company's effort to diversify its revenue stream and reduce dependency on retail alone. Overall, Aon's business remains rooted in retail, but its evolving revenue composition shows a fast forward looking strategy aimed at the long term growth and stability.
Next part is the listing down of asset components for both companies. As in the slide, I've already put the main sources of funds for both Mr. DIY and Aon Company. Let's take a look at the first company, Mr. DIY. Their main sources of funds are property, plant and equipment, PPE, and right of use assets. These two are non-current assets. Other than that, Mr. DIY also depends on inventories and cash and bank balances, which are the current assets. On the other hand, Aon Company depends on property, plant and equipment, PPE, and right of use assets, which are the non-current assets, and also they depend on inventories and cash equivalents, which are the current assets. All those aspects are the main sources of funds for these companies. Since we have all of the asset components, we can now analyze the trend changes of assets in between the 3 years for both companies. Let's start with Mr. DIY. By the way, this graph is much more clearer and better in the Excel sheets. Alright, so for Mr. DIY, firstly, the bigger picture. Mr. DIY showed remarkable consistency, growing steadily from 3.32 billion ringgit in 2022 to 3.8 billion by 2024, and that is a solid 6 to 7% increase each year. What this reflects is their stable retail expansion model. Secondly, now where did this money go? Mr. DIY allocated 37% of assets to leases and 23% to store expansions, essentially doubling down their retail footprint and inventory. Basically, every ringgit that they have was about strengthening their store network. Thirdly, how did they finance all of the process and make this thing achievable? Mr. DIY built up an impressive cash safety net. Their reserve jumped 68% in 2023 alone, reaching 7.3% of total assets by 2024. This gives them a very tremendous amount of flexibility to begin with. Our second company then, Aon. Aon's journey was much more dynamic. They took a 3.7% dip in 2023, mainly due to strategic lease reductions, but then they rebounded strongly with 7.9% growth in 2024, reaching 5.63 billion. This up and down pattern perfectly illustrates the volatility of property-focused business as compared to Mr. DIY's retail stability. Secondly, Aon also played a very different game as compared to Mr. DIY. A massive 55% went into property assets with another 21% to leases. While Mr. DIY was optimizing store shelves, Aon was literally building the shopping malls those stores sit in. Two fundamentally different approaches to achieve growth. Aon's lifeblood is property cash flow. After a cash slump in 2023, they rebounded back to 6.6% reserve in 2024. While less liquid than Mr. DIY, their model generates stable, long-term income from those small investments. So all in all, what does this tell us? Mr. DIY offers investors agility through retail growth and strong cash reserves. On the other hand, Aon then provides stability through property assets, even though with some cyclical ups and downs. Both strategies work, they just cater to different risk appetites and time horizons. For potential investors, their choice comes down to preference, whether consistent retail growth with Mr. DIY or property-backed stability with Aon.
Now, for the third financial segment, list the total liabilities of each company for the 3 years. Discuss the trend of the total liabilities and its components. Which component of liabilities should be the main concern to the company? The first one is Mr. DIY. In 2022, total liabilities were around 1.89 billion ringgit, dropping to 1.80 billion ringgit in 2023, but rising slightly to 1.86 billion ringgit in 2024. Now, for the explanation of liabilities, Mr. DIY company, total liabilities decreased from 2022 then increased again in 2024. These liabilities are the largest component every year. Borrowing have decreased over the 3 years, especially current borrowings. Trade and other payable and current tax liabilities have increased each year. Provision for restoration costs and deferred tax liabilities are relatively small compared to the other components. Lease liabilities are the main concern because they make up the largest portion of total liabilities and have increased each year. Managing lease liabilities is important as they represent long-term financial commitments and can impact the company's cash flow and financial flexibility. The company should also monitor the rising trade and other payables and current tax liabilities, but lease liabilities remain the most significant risk. Now, let's look at Aeon liabilities over the 3 last year. In 2022, the total liabilities were about 3.62 billion ringgit. In 2023, they decreased to 3.36 billion ringgit, but then rise again in 2024 to around 3.7 billion ringgit. Now, for the explanation of liabilities of Aeon, total liabilities decreased from 2022 to 2023, then increased significantly in 2024. Borrowings fall in 2023, but increased sharply in 2024. Lease liabilities decreased in 2023 and increased slightly in 2024. Other liabilities remain relatively stable over the 3 years. These liabilities are consistently the largest component and represent a significant long-term commitment. The sharp increase in borrowings in 2024 is also a concern, as it could increase financial risk and interest expenses. Companies should focus on managing lease liabilities and closely monitor the increase in borrowings.
The fourth financial statement is for each company, which is the main type of financing, liabilities or equities. What is the percentage for each? So this is Aeon, and on the year of 2022, the equity percentage is 33.30% and the liabilities is 66.7%, and the main financing type is liabilities. Next, on the year 2023, the equity percentage is 35.59%, while the liabilities is 64.41%. And this concludes that the main financing type is liabilities. Lastly, on the year 2024, the equity percentage is 34.38% and the liabilities percentage is 65.60%, which concluding the main financing type as liabilities. A little bit of explanation on the Aeon's capital structure analysis from 2023 to 2024. Aeon is primarily financed through liabilities in all 3 years over 64% each. Equity contributions remain relatively low, ranging from 33% to 36%. The highest reliance on liabilities was in 2022, which is 66.70%. Although equity has slightly increased over the years, debt remains the dominant financing source. This indicates a debt-heavy capital structure, suggesting possible higher financing risk. Throughout 2022 to 2024, liabilities consistently accounted for about 64 to 67% of total financing, clearly showing a liability-dominated capital structure across all 3 years.
So now for Mr. DIY, in the year 2022, the equity percentage is 43.11%, while the liabilities percentage is 56.89%. The main financing type of this year is liabilities. For 2023, the equity percentage is 49.15% and the liabilities percentage is 50.85%. And the main financing type of this year is also liabilities. For the year 2024 though, the equity percentage is 50.96% and the liabilities percentage is 49.04%. And so the main financing type of 2024 is equities. The main financing type, it shifted from liability dominated to equity dominated. In 2022 to 2023, liabilities slightly dominated, with about 51% to 57%. In 2024, equity becomes dominant, approximately 51%. So the trend is that the equity financing gradually increases. Now, to explain Mr. DIY's capital structure through the years 2022 to 2024. Mr. DIY is primarily financed through liabilities in 2022 and 2023, over 50% in both years. In 2024, Mr. DIY was mainly financed through equities. Equity and liability contributions remain relatively similar through the years, ranging between 43% to 57%. Over the years, reliance on debt has decreased and equity has increased. This indicates they are moving away from a debt-heavy capital structure, lowering their financial risk. In 2022 and 2023, liabilities made up over 50% of total financing, indicating a liability-dominated structure. But by 2024, equity slightly surpassed liabilities, shifting the financing to equity-dominated.
So the final question is compare and contrast the results of these two companies. Discuss which company is financially healthier and why. So let's start with the net profit growth. Mr. DIY showed a cumulative profit growth of 20.3%, while Aon recorded 15.1%. This means Mr. DIY had stronger and more consistent earnings performance. Next, we look at their capital structure. In 2024, Mr. DIY was financed more by equity at 50.96%, while Aon remained more debt reliant with liabilities making up 65.62% of its financing. This suggests that Mr. DIY carries lower financial risk. Then, in terms of liquidity, Mr. DIY also had a higher percentage of cash compared to Aon, indicating a stronger ability to meet short-term obligations. Looking at their asset allocation, Mr. DIY maintains a balanced mix of inventories and retail operations, while Aon's assets are heavily tied up in property. Lastly, in terms of revenue focus, Mr. DIY is 100% retail focused, showing a simple and scalable model. Aon, on the other hand, is more diversified but less focused. So, which company is financially healthier? In conclusion, Mr. DIY is financially healthier overall due to its stronger profitability, lower debt levels, better liquidity, and focused business model, making it more stable and efficient in the long run. That's all from us. Thank you.